Most people use banks every day. We deposit our paychecks, swipe our cards, take out loans, and pay bills online. But have you ever stopped to ask a simple question? How do banks actually make money? After all, banks seem to give us money, store our money, and move money around for us. So where does their profit come from? In this video, we'll break down exactly how banks make money, step by step, in a simple and easy way to understand. Let's start with the most important concept in banking: interest. Interest is the foundation of how banks make money. When you deposit money into a bank, the bank doesn't just lock it in a vault and wait for you to come back. Instead, it uses most of that money to lend to other people. For example, imagine you deposit $1,000 into your savings account. The bank might pay you a small amount of interest, maybe 1 or 2% per year. That means after a year, you earn a little extra money for keeping your funds there. But now, the bank takes that same money and lends it to someone else, like a person buying a car or a home. That borrower might pay 5, 6, or even 8% interest on their loan. The bank keeps the difference between the interest it pays you and the interest it earns from the borrower. This difference is called the interest margin, and it's one of the biggest ways banks make money. This system works because not everyone withdraws their money at the same time. Banks only keep a small portion of deposits as cash and lend out the rest. This is known as fractional reserve banking. Next, let's talk about loans in more detail. Banks make a lot of money by issuing different types of loans. These include home loans, car loans, personal loans, business loans, and credit cards. Each loan comes with interest, and over time, that interest adds up to a large profit for the bank. For example, a 30-year home loan might cost the borrower hundreds of thousands of dollars in interest over its lifetime. Credit cards are especially profitable. Credit card interest rates are often much higher than other loans, sometimes over 20% per year. If customers carry balances and don't pay them off each month, banks earn significant interest income. Even small fees on loans, such as application fees or late payment fees, add to a bank's earnings. Now, let's move on to fees. Banks charge fees for many everyday services. Some are obvious, and others are hidden in the fine print. Common bank fees include monthly account fees, overdraft fees, ATM fees, foreign transaction fees, and late payment fees. Even a few dollars per customer can add up when millions of people are using the bank. Overdraft fees are one of the most profitable. If you spend more money than you have in your account, the bank may allow the payment to go through and then charge you a fee. That single mistake can cost you tens of dollars instantly. Banks also charge businesses fees for processing card payments. Every time you tap your card at a shop, the bank takes a small percentage of the transaction. Another major source of income is investments. Banks don't just lend money to individuals. They also invest in stocks, bonds, government securities, and other financial assets. These investments generate returns over time, especially when markets are doing well. Large banks often have entire teams dedicated to managing investments and trading financial instruments. Even small changes in interest rates or market prices can generate millions in profit. Next, let's talk about wealth management and advisory services. Many banks offer financial advice, investment accounts, retirement planning, and managed portfolios. Customers pay fees for these services, either as a flat fee or as a percentage of the money being managed. For wealthy clients, these fees can be substantial. Managing millions of dollars, even at a small percentage, creates a steady stream of income for banks. Banks also make money through business services. Businesses rely on banks for payroll, loans, merchant services, foreign currency exchange, and cash management. Banks charge fees for these services and earn interest on business loans. International transactions are another profit source. When money is exchanged between currencies, banks take a margin on the exchange rate. Now let's touch on something people don't always think about: time. Banks benefit from time because interest compounds. The longer money stays invested or loaned out, the more profit it generates. This is why banks prefer long-term loans and long-term customers. Even small interest differences become very large amounts over decades. Finally, let's address a common misconception. Banks do not simply take your money. They operate by moving money between savers and borrowers. Their profit comes from managing risk, charging for services, and earning interest on loans and investments. Without banks, lending would be far more difficult, payments would be slower, and businesses would struggle to grow. However, understanding how banks make money helps you become a smarter customer. By avoiding unnecessary fees, paying off high-interest debt, and choosing the right accounts, you can keep more of your own money instead of giving it to the bank. So the next time you walk into a bank or open your banking app, you'll know exactly what's happening behind the scenes. That's how banks make money. If you found this explanation helpful, don't forget to like the video, subscribe for more simple explanations, and thanks for watching.